everyone, Nick Fenton here with part 4 of the options strategy series here. Changed locations, and it's been a long day, so bear with me. I might make a few mistakes here, a little tired. Anyway, let's just quickly recap what we've talked about in 1 through 3. In 1, we talked about the scan settings that I utilize and how I most effectively and efficiently utilize said scan settings results. And how I link up the gadgets area on the far left, which we don't have shown here, but if you just go down to the bottom left hand and open the gadgets right there, there's your gadgets. So here's the scans. So how we link up the gadgets to the trade tab and the risk profile and the charts. That's just a really efficient way to do it. It also allows you to quickly determine liquidity and the options of said underlyings that show up in your scan. We discussed the core framework, which I'm not going to reiterate because we've talked about it so many times. And we discussed the duration window for this particular strategy, which is 25 to 50 days is our acceptable range with a 30 to 45 day sweet spot. We also talked about how to choose your strikes and how to go ahead and build the spread once you deem which month you're going to be trading in. We looked at shorting the short strikes were the strikes that had about 30% probability in the money. And then in the case of GDX, since it's a low-priced underlying, we went 2 points wide. But in some of the higher-priced underlyings, I prefer to go 3 to 5 points wide and sometimes 10, 15, 20 points wide. But generally, I'm in the 3 to 5 point wide area in most cases. In this lower-priced underlying, kind of forced to go 2 points wide, maybe 2.5 max. But 2 points is pretty much the comfort zone for something as cheap as GDX. So, we also, after we built it, we discussed the minimum probability, the minimum acceptable credit that we are willing to receive for entering the spread. And, that's 30% the width of the spread. In this case, the width is 2. 30% of 2 is 60 cents. And we are well above our, 5 cents above our minimum acceptable credit here in this particular example. So what next? Next, we need to determine, since GDX has passed all the criteria so far, it's liquid, it's diversified underlying, which is preferable but not mandatory. There's no earnings risk since it's an ETF. The month that we're using is within our duration range. The strikes that we chose were, reasonable based on the strike choosing criteria. And after choosing those strikes using that criteria, we came up with a credit that happens to be right about 30% the width of the spread. So far so good with GDX. What next? Next I like to see what the probability of success for this particular spread is. And my minimum acceptable probability of success personally is 55%. Generally I'm in the 55 to 65% range. So that's generally the range that these Iron Condors with this style are going to come up with. So let's see if we stay in that range. And how do you determine? So what you do is you right click on the trade down here at the bottom and then left click Analyze Trade. And that's going to take us over to this screen here. This is our risk profile on the Analyze tab. So first I'm just going to kind of maximize the screen so we get as much risk profile on the screen as possible. Then you can kind of grab, left click and hold, and you can move that around right and left. You can grab down here on the numbers and you can shrink it, or you can slide right while you're holding left click down, and you can expand it a little bit. So there we've got a nice good image of the Iron Condor. Next thing you want to make sure of is that your probability date up here at the top right correlates with your expiration month that you're using on the spread. So we're using December 2014 options. So we want to make sure that we're looking at the Saturday settlement date after Friday expiration. So Friday expiration is always going to be this green highlighted number, third Friday of the month. So the Saturday obviously is the following day. So just left click that, it was already accurate. And the last thing we need to do is click this circle with 3 lines in it. I don't necessarily know what to call that icon. Here we go. It's the Actions menu. So Show Actions menu. Click that, go to Set Slices, go to Break Even, and choose that same 12/20/2014 date. Left click. So that's going to set your slices. These are your slices. Your dotted red vertical lines here are your slices. So, the slices are automatically set right up to your break-even points. So here we have our lower break-even at 1735. Here we have our upper break-even at 2165. In the middle, we have our probability of staying in between those break-evens. As you can see here, the probability is showing at 55.59, so we're right at the 55 number pretty much, which is perfect. So that's GDX continues to meet all the criteria that we're looking for. This is pretty much the last one I check off the list from an entry perspective. So, what do we have going on here? What does this tell us? It's also telling us there's about a 21% chance that we'll get tested on the downside. There's about a 23% chance that we'll get tested on the upside. It's not necessarily a test. It's just kind of giving you the other sides of probability. So this is pretty evenly directionally skewed, with 23% on the upside, 21% on the downside. If you do directionally skewed things, so say you want a little bit more protection against a big downside move, you may change your legs to where you have more room for the stock to go down, more cushion on the downside. So say this number might be 10%, and then this number might be 33% or something like that. So that's how you can directionally skew things. But that's kind of a different conversation. In this case, we have a really balanced, directionally balanced, and we have no unbalance in. So we have a balanced directional skew, and we have an overall just balanced width of spreads, 2 points wide on each side. So this is a very balanced overall Iron Condor. So this meets our minimum probability of success requirement. The last thing I like to do here is get a visual of what do these break-evens look like on the chart, and all you have to do that is go here to that Actions menu again, hit this Slices to Chart, or just hover over it, and then left-click the top left square. That automatically puts your break-evens on the chart. Let's expand that price chart a little bit and bring this volatility chart up a touch. So what you can see here is these black dotted horizontal lines represent the slices that we just saw in the Analyze tab. Now, I believe they default as solid black horizontal lines, but I've changed them to dotted. I'm not exactly sure. I don't quite remember how I did that. But that's not important here. What's important is how does this look? So my personal takeaway would be as follows. Okay, back in early part of the, or what was that? That was late 2013. So in December, we saw a lot of congestion in this particular area here, right around the 20. We'll just call it the 2150 area. There's a lot of congestion right here. It broke down through it. It acted as quite a bit of resistance for the entire month. It finally broke above it, retested that resistance turn support, and popped strong. Didn't really test that level again until May here, the end of May. And sure enough, that resistance turn support held, and we saw another strong bounce. Came back and retested that resistance turn support level and actually broke back through it, turning that support back to resistance. Then it, since then it's tested it from a resistance perspective, and it's, there's a lot of congestion there before it absolutely tanked, making new multi-year lows. So this overall line, I could see it possibly holding as a resistance line if GDX were to retest there, which would be beneficial because that would push it back down and back into the range, the Iron Condor range. On the flip side, how does the break even on the lower end look? Well, we don't have a whole lot of previous price data to look at because these were multi-year lows. All we can really say is there was a lot of congestion down around this area here. And it did attract some buyers at these levels. It finally popped up, and then it retested. And that one day right there that it retested, we're talking about a strong pop off of that price point, or that price area, I should say, that support area. So in the event it was to retest back down at these levels, I'd feel pretty confident that it would attract buyers again. There's no guarantee, obviously, but it looks pretty good. So if it were to tank again, I think it might attract buyers again down here at these levels, which of course would push it back up into this range. So overall, this looks pretty good visually from just that small observative perspective. if you will. Would I like it to be a little bit wider? Sure, I would especially like this to be a little bit higher, the upper break even to be a little bit higher. But all in all, can't get too picky. This looks pretty good. I like it. So visually, again, that's just kind of how I go about it from a visual perspective. I keep things pretty simple. I don't bring in a whole bunch of technical parameters. I just kind of look at the price action at specific levels in relation to where the break-evens reside on the price chart. So let's take it back to the Analyze tab real quick before we cap off this part 4. And I just want to kind of go over what we're looking at here in this risk profile one more time. I've talked about it in many videos, but let's just go over, refresh. So here on the y-axis, we've got our profit loss. Right here's our 0, which is our break even, meaning making no money on the spread. Anything above that is, of course, positive, so we've got our profit. And anything below that's negative, so we've got losses. And then on the x-axis, we've got the prices, different prices of the underlying, in this case, GDX. So here's GDX at 16, here's GDX at 17, 18, 19, 20. Here we have our risk profile, and so basically what you're seeing is up here where this is our max profit. You can't make any more money than this plateau profit area, and that max profit resides in between our short strikes. So you can see we have a short 18 put right here, and we have a short 21 call. So max profit resides in between the short 18 put and the short 21 call. So if GDX expires between 18 and 21, you achieve max profit. Your max profit is, if you look down here at the bottom left, this red date is the 12/20 date that we've correlated with everything, our probability date, our slices. And that's going to tell you what your max gain or loss, or what your gain or loss is at any given price point in GDX. So if we're to go over here to 20, and you look down at that red number on the bottom left, you'll see it says 65. So our max gain is 65 right there at 20, and you see that that number does not change as I move between 18 and 21. So no matter what, if we're between 18 and 21, 65 is going to be the profit number. So let's take a look at the downside. If we go just a little below 18, you can see that profit starts to reduce slowly. And then when we get to our break even at 17.35, there's no profit. It's just break even. Then as we go below 17.35, you can see that we start to accrue losses slowly until we hit that long put strike, which is 16. Then those losses stop. They're capped out. That's our defined risk. So you can't lose any more than 135 bucks. GDX can go to 0 and you still only lose 135 bucks. Same with the upside. As we go above our 21 short strike on the call side, we start to see those profits reduce slowly as we move towards our break even. And once we hit the break even, of course, we've got break even price. As we go below the break even, we start to accrue some losses, and those losses continue to build as we go towards our long call strike of 23, where we actually hit our max loss on the upper end. Same price. Most you can lose on the upside is 135 bucks. So this thing can go to $2,000 and you're still going to only lose 135 bucks. So defined risk is very similar to, it has similar properties to a stop loss, but it's better than a stop loss. So if you trade stocks and you put a stop, you say, let's use this $135 max loss as an example. So say you trade a stock, you buy a stock, and then you set a stop that you say when you enter the position, I don't want to lose any more than 135 bucks on this position. So you set your stop at the price point that translates to you losing $135. Well, if the stock moves down to that price point, then your stop triggers and you're forced out of that trade. But you've accomplished your goal of not losing any more than 135 bucks. Well, in the case of an Iron Condor, you get that same luxury of saying, you know what, I don't want to lose any more than 135 bucks, so I'm only going to do one lot of this Iron Condor. You achieve that goal of making sure that you don't lose any more than 135 bucks, but if GDX is to rally up to, say, 24, you're not forced out of the trade. There's not a specific price that forces you out of the trade. If you have enough duration in the trade, you can continue to hold that position, and maybe GDX fades back into this range. Maybe it fades back to 19. So the only thing that's going to force you out of the trade is your December December options expiring. So as long as there's duration, you're never forced out of the trade, but you do have the luxury of having that defined risk intact, which is it's a pretty nice thing. So that's it for part 4. We'll see you soon in part 5. Hope you're enjoying this so far and hope you're retaining. Of course, if you have any questions, you can always leave them in the comments of this video. You can email me at nick@nickfenton.com, but I do prefer that you leave it in the comments so anybody else that might have that same question can see it in the comment section and see my answer.